So the building a trading strategy consists of, let's say, 3 parts or 3 blocks. Your execution or trading plan, your back testing, and risk management. Now, to define the trading plan or execution plan, you have to define basically 2 things. The entry, A, which is the entry point, or let's say when you are going to buy or going to sell financial security, and B, the rules for which you exit that trade. Either you exit the trade for a profit or for a loss, but though that exit strategy has to be defined in a set of rules. And so going back to the entry strategy, the entry rules must be also well defined. It's good practice to write these things down so that you know exactly what are the rules defining entry and exit points. Now to determine your entry and exit points, you need to decide which type of trading suits you best. And to decide which type of trading suits you best, it's very personal matter. Some traders are very happy to put on a trade and wait a long time, let's say a number of days or maybe even a week, before they take a profit or the trade hits the stop loss. Other traders are more inclined to want to trade, let's say, over a very short time period. So perhaps enter a trade and see the trade go in their favor very quickly, and perhaps the trade lasts an hour or 2. Sometimes maybe it's just several minutes or 10 minutes. So it depends very much on your personality, on how you see the markets that you want to trade in. And it also another aspect that will also define your trading plan is the type of market you are going to trade in. Usually a trading strategy, a trading plan for entry and exit points usually only works in 1 of 2 markets. The 2 markets are environments that usually happen with any financial security as a trending market, or a sideways market. Trending market can be seen on the chart, like this chart that we're seeing right now. And you can see that there are consecutive higher highs and lows. So the highs keep going higher, the lows are continuously lower than the previous lows. Yeah, so it's very clear that there's a trend, in this case, an upward trend. And the other type of market is a sideways market. And this is where there's no clear trend. So you can usually create a box or a rectangle, and most of the price action will happen within this rectangle. Yeah, this is a typical sideways market. In this case, the dollar Swiss franc on the 4-hour chart. So it's necessary to define which type of markets you want to trade. Statistically, we know that 60% of the time markets have a trend. And in the 60% of the time, the market is going up in a fairly obvious way, or it's going down, but it has a clear trend. And 40% of the time, it's moving sideways, yeah, and within a boundary, an upward limit and a downside limit, and most of the price action occurs in that's the sideways trend. So there are 2 things to establish: what type of trader you are. If you prefer to have your trades on for a long time and you're willing to hold on to that trade and see if eventually it makes a profit, or if you want to have a short time frame for your trading, And perhaps if it's your trade will be on for an hour or two at the most, and you either take a profit or you take a loss. And the other factor is deciding if you want to trade trending market or if you want to trade a sideways market. So another thing to consider will also be the time frame over which you want to trade. Some traders might look at a chart like this one, which is a day chart, a daily chart on the euro dollar. And they'll be very happy to enter a trade at some point, let's say here, and wait for it to go up many days before they take a profit. And other traders will look at a shorter time frame, and perhaps they'll look at a 15-minute chart, or perhaps they'll look at a 1-hour chart, because they're looking to trade over a much shorter time period. This also builds into another type of aspect of what type of trader you're going to be. Some traders are day traders, they're called, whereby they take a position perhaps in the morning, or take various positions throughout the day, but they close those positions throughout the day also, meaning there are no positions held overnight, and that's what's known as a day trader. And other traders, are often known as swing traders, are willing to keep their trades open for several days to catch a big trend, usually, to catch a big trend like this one, and trade, therefore you're trading less and keeping your trade open for longer. So that's also another factor to consider if you're going to be day trading. Perhaps you're going to open a position in the morning and leave it open until the evening, but you're going to close it before you leave your computer and go to do something else. So that when you're building your trading plan and you're building your rules for entry and exit, you need to define under which rules those two things happen. Most traders are technical traders, meaning they'll be using charts like this one, but they'll also be using perhaps technical indicators, perhaps more than one. They might also be using chart patterns, especially candlesticks are very popular at the moment. So perhaps if you see a chart pattern, example of these two candles here, there's a 2-candle chart pattern. That indicates there may be more downside momentum. In fact, it comes down 1, 2, 3, 4 days after that. And other candle patterns of the type. But I always recommend to use more than one technical analysis or technical tool. Drawing trend lines is a very appropriate tool as well. Establishing support levels and resistance levels as well is very important. And for example, in this chart, this is a chart with a couple of indicators. The first indicator is the moving average. Yeah, I have 2 moving averages here. The slow moving average, which is the blue line, and the fast moving average, which is the orange line. And this indicator works in such as when the fast moving average, the orange line, crosses above or below the blue line, you get an indication of which direction the market is likely to move. Now, if you use it alone, use it by itself, it can produce perhaps some good results. But perhaps if you use it with other indicators, it might improve your profitability, your win ratio. On this chart, we also see the Ichimoku cloud. Ichimoku cloud tells us whether the market is in a bull market when it's above the cloud, or when it's below the cloud, like in this part of the chart, tells us it's in a bear market. So perhaps, for example, in this area here, the moving average, there was a crossover on the moving average. But perhaps if you're using the cloud, you're going to wait Yeah, perhaps you're not going to buy it here because there was a crossover on the moving average. Perhaps you're not going to buy it because it's still below the cloud. But you can see that using more than one technical indicator together can help us establish a set of rules that may prove to be more profitable, to have a higher win ratio than if we just use one set of rules. Okay, and then for the exit points, we also have to use various tools that are at our disposal. Perhaps the strongest are resistance and support levels. For example, if you see that the market, you join the market, you sit down and you see this part of the chart, and you say, okay, the price action is above the cloud, the moving average has crossed over at this point and it's bullish. Okay, I'm going to put a buy trade here, and you're going to have to identify a stop loss. The stop loss, you could say, okay, I could put it just a bit below where I buy, but this area acts as a support. The cloud is also known to be very effective as a support and resistance. As price is above the cloud, then this becomes a support. So placing your stop loss here wouldn't be very effective. Perhaps it would be better to place it down here, where it means it might have broken the cloud and potentially there is more room to the downside. That way you don't risk being stopped as it bounces off the support. But when you want to identify exit points, exit rules, it's necessary to be aware of how much volatility the market has. For example, a big down candle here. If you place your stop loss too close to your entry point, let's say you bought here, you place it a bit too close to your entry point, with this candle, you would have been stopped out and then it went back up again. It's necessary to understand the volatility of the market. So if it's very likely that the market could come down in one candle and you bought here, and perhaps your stop loss, if you bought here, would have to be down here. Would have to be down here because it also broke this support line here. Yeah, so this price action down here would indicate more price action on the downside. There are other considerations you can make to decide on your exit points also, and they can be guided simply on things such as your maximum stop loss, meaning the maximum amount you're willing to lose when you enter a trade. A couple of people on wait to enter, I believe. I'll let them in. Perhaps I'll let them in more. So somebody's asking a question in the chat, I believe. Or is that somebody else? I know that
actually, I see. Sorry to interrupt.
No, that's okay. No, right. So those are the main considerations when establishing your trading plan, your execution plan. Identifying the rules for entry, that is to say the rules to buy and sell a financial asset, which can be based on technical indicators. There are many in the market. Many have been used for decades. Obviously, they have some success, but I think what is mostly important is that as a trader, you identify the technical indicators and tools that make sense to you and that work well for you, because some indicators are very, at least for me, from my personal experience, are very easy for me to understand, and I can see how the price action is aligned with the technical indicator. So I see that a specific indicator might work for me. The Ichimoku cloud certainly works for me. I understand it very well. Moving averages is also one that I find very easy to understand. Then there are many others that are very popular, like MACD or RSI or Elliott Wave theory. But it's really a matter of reading, studying these technical indicators, and then understanding if they actually do work for you, and if they work within your trading plan. Meaning, do they work for trending environments, or do they work best on a sideways environment? If you're looking to trade a sideways environment, then you want to test technical indicators and tools that work very well or work best on a sideways environment.
Gino, I don't know if you allow me to interject something real quick.
Sure.
I don't know how you want to operate, if you want to go all the way to the end to get questions from our participants, or if you want to allow any attendee to jump in and ask a question. It's up to you. I don't know.
Whatever the attendees feel, if they wish to ask a question, they can interrupt me. I'm fine with that.
Okay, wonderful. Thank you. I see Yaya Chem with hand up. So as we have the permission of our presenter, Yaya, go ahead and please ask your question at this time.
Good afternoon, sir. Thank you so much.
Good afternoon.
I have a concern here. I couldn't hear the presenter. I was really struggling to hear what he was saying. I don't know whether he's on my side or his side over there. But actually, since the beginning of the lectures, I've not heard anything that I can take away from the lectures. Really,
Right.
that's my problem.
Let me respond to that real quick, Gino.
Sure.
I would recommend, Yaya, that you double check audio settings on your system, because we don't have any issue at all with the sound. We have no complaints from other participants. And please take a little time to double check your audio settings, speaker, and output from your computer. And I'm convinced this will resolve the problem. Besides, let me say it right now, that if you have anything that you don't quite get, don't hear very well, whatever that is, during the presentation from Gino D Alessio, the recording will be made available to all of you, ladies and gentlemen. Thank you very much for your cooperation on this. You may proceed, Gino, at this time, please. Thank you.
Thank you very much. Right, so, okay, so where are we going now? So now the next part. So where were we? Yeah, we were talking about the entry rules and how you want to make sure that first of all you understand and that they work for you, the technical indicators and tools that you are looking at and that you have studied previously, and that they work in the type of market that you want to trade in, depending if it's a trending market or if it's a sideways market. Now, let's say once you have established your trading rules, so you've studied various technical indicators, you've been watching financial market of your interest, you've been looking at how those indicators apply to the price action you see on the charts. You've built some rules for entry and other rules for exit. Okay, we have another couple of questions. I'll go ahead. I don't know who was first. I'll give Cryptofina a chance now.
Cryptofina, we already heard from Yaya Chem. Cryptofina, go ahead, please ask your question at this time.
As well, I cannot hear very well. He must lift up his voice a bit It's
Yeah.
really a problem today. I cannot hear well also this side.
Can you hear me? Can you hear me now? I'm right next to the microphone.
Yeah, I can hear you. I can hear you a bit, but sometimes the volume is down, very, very down.
Yeah. Does anybody else have that problem? Because
On my end, personally, there is no issue whatsoever. And let me.
But the truth, I can hear you. I can hear you very well. But the lecture, I can't hear very well. Maybe his side or
that's
okay.
interesting.
But I can hear a bit. It's fine.
Okay, I'll try and speak up as much as I can. Maybe if I speak up a little
Yeah.
bit more. Does that
All
help?
right.
Okay.
Yeah. Okay.
Yeah.
Okay.
Okay. So, let me continue. So I was saying, so once you have defined your entry and exit rules, how do you know this is going to work? How do you, how can you establish if the rules of entry and exit that you defined, and that obviously you've studied very carefully, if they are actually going to work in the financial market that you are looking to trade? Well, the main thing we can do is basically two things. You have two possibilities. One is open a demo account with a virtual trading money and start trading virtually without risking any dollars. But this is very time costly, because it will take you many, many months, perhaps a year, to effectively test your trading strategy, your execution plan, to see if it is viable. So the other opportunity is to use backtesting. And backtesting can be done on various platforms. On the MetaTrader MT4 and MT5, you can do backtesting. You can also do it on TradingView. And then you can do it on paid software such as Forex Tester, Soft for FX, and FX Blue Simulator. Now, the thing about the first two is that they do have backtesting capabilities, but they tend to be geared more for automated trading. So if you have, for example, an expert advisor or a trading bot, MT4 and MT5 and TradingView are two platforms that are specifically more geared for that type of backtesting. Whereas the Forex Tester, the Soft for FX, and the FX Blue, they're set up for manual backtesting, which is probably what the majority of retail traders are likely to be doing. In my case specifically, I trade manually. I'm a discretionary trader. I don't have any automated trading bots. So I have to do my backtesting in the same way. So you have to use backtesting software that allows you to see the markets from previous years and go forward candle by candle and see how the market evolves, how your technical indicators apply, and see when your entry rules are met, and place a virtual order on the trading software. And the good thing about this type of software is that they track a lot of information. Not only do they track how much money you may have won or lost, they will also track things like your maximum drawdown and your win-loss ratio, two very important things that we need to consider when we're doing backtesting. So the total gains for the period obviously is very obvious. The profit and loss that you achieve during the backtesting period. And then we need what we call the win ratio, and win ratio is the number of wins per losing trades. For example, if you have a win ratio of 60%, then 6 out of 10 of your trades are winning trades. Okay, so we need to establish that we have a majority of winning trades, right? We don't want to be trading a trading strategy that has a very low win rate. Another factor which is very important and probably is the first thing that we are going to look at from the back testing data is the maximum drawdown that occurred while we were back testing. The maximum drawdown is the maximum amount of money your fictitious account lost while you were back testing. Let's have a look. Solo wants to say something, I see. Oh no, it's gone. Ritofina, did you leave your hand up from before, or are you asking another question? I think she left her hand up from before, yeah?
No,
Possibly.
what I understand that some participants sometimes they forget to
Yeah.
remove the option, so that's probably what happened. Yes.
Okay, yeah, so I was saying the maximum drawdown is a maximum amount of money that your account lost while you were back testing. Let's say you started your back testing with a $10,000 virtual account, and throughout your back testing, at some point, you were down $1,000 or $2,000, let's say. Well, then you know that your maximum drawdown was $2,000 or 20%. And this is important when we're looking at backtesting data, because your maximum drawdown is also going to be your maximum risk tolerance, meaning when you go into trading, you have an idea of the amount of money you're willing to risk, yeah, before you actually stop trading. And perhaps you want to start, I'm just going to use an easy figure, $10,000. You want to start trading with $10,000. It's very wise, I believe, to put a number as to the amount of money you're willing to lose before you stop trading. Because clearly it doesn't make sense to lose $10,000 before you actually stop trading. If you're trading and you continuously lose money, at some point you should ask yourself, what am I doing wrong? And therefore you should want to stop. But how do you know when to stop? I believe that depends on our maximum risk tolerance. So if my maximum risk tolerance, or the amount I'm willing to lose, the maximum amount I'm willing to lose is $2,000, well, then we already have a piece of useful data, and that is that the maximum drawdown should never exceed $2,000. So when we are back testing the trading strategy, we will automatically discard any trading strategy that has a maximum drawdown which is greater than 20% or $2,000. Yeah, I hope that makes sense. And then we also need to look at, with the backtesting data software, will also show us the average win per trade and the average loss per trade. These are two important pieces of information, as we shall see shortly. Because intuitively, if your average win per trade is, let's say, $100, but your average loss per trade is $300, that doesn't look too inviting, right? Because you would have to get it right. A very high percentage. You would have to have a very, very high win ratio to avoid actually losing money. Yeah, because your average win per trade is $100 and your average loss per trade is $300. So we don't particularly want that kind of averages. So these are the insights that you get from the backtesting data: the win ratio, the maximum drawdown, which will also be or should coincide with your maximum risk tolerance. And what I mean is that when you go to backtest your trading strategy, you will automatically discard any trading strategy that has achieved a maximum drawdown, which is greater than the amount you're willing to lose. Yeah. So speaking about the average, to put things together, the average win per trade and average loss per trade, and your win loss ratio or your win rate. Let's have a look at an example, which will help us understand why it's important to have an average loss per trade that is low, preferably lower than your average win per trade. So let's say you have back-tested a strategy and you achieved a win rate of 70% with an average loss per trade of $200 and an average win per trade of $100. Let's say you placed over several months, you placed 100 trades, you made 70 times 100, which is $7,000. And then you lost on the other 30 trades, you lost 30 times 200, that's $6,000. So your total profit would be 7,000 minus 6,000 would be 1,000. That might look satisfying, but I would consider that to place 100 trades manually would take several months, unless you're a very high frequency trader, in which case it might take you just perhaps 10 or 20 days. But in general, for most retail traders, it would take several months. And $1,000 might seem satisfactory, but it doesn't look that good if we consider it's $1,000, it's 10% of your capital. You probably would have needed $10,000 to be able to create this scenario, and making only $1,000 over several months is probably not the best trading strategy you should be looking for, especially when the average loss per trade exceeds the win per trade. So what happens when the average loss per trade is decreased? This can be achieved by reducing the stop loss, meaning reducing the amount of money you're willing to risk on each trade. What happens when you do that is usually your win rate will decrease. Yeah, because some trades will get stopped out prematurely, and although you lose less per trade, your win rate will probably decrease. But looking at another example where you have reduced your average loss per trade, yeah, your win ratio has decreased a little bit, down to 65% win ratio, and your average win per trade remains the same, $100. In this case, you'll see that the profit is $6,500, the loss is $4,375, and you made a profit of $2,125. Already that's an incredible increase over the previous backtested data. This is presuming we've run a backtesting data, right? And we did 100 trades, and we got the result of average loss per trade of 200, and we had a result of an average win per trade of 100. So this looks like it might have been satisfactory, but if we tweak our rules a little bit, and we manage to get an average loss per trade which is lower, even though it reduces the win ratio and makes it 65 instead of 70, we can see that we get a better result. Yeah, so it's important to establish with your back testing that the average loss per trade is preferably lower than the average win per trade. Looking at another example, let's say we continue to tweak our execution plan and we achieve an average loss per trade of $75 and an average win per trade which stays the same at $100. Our win ratio declines still a bit further, And again, we placed another 100 trades. Excuse me. We can see that the profit is now $6,000 minus $3,000. And we had an overall profit of $3,000. And this looks a lot more attractive, I'm sure, to everyone than the first example. And it is all because we managed to reduce the average loss per trade to $75. And we managed to reduce that loss per trade to an amount which is lower than the average win per trade, despite the win ratio being lower than the first example. Yeah, so the win ratio is important, but when the average loss is lower than the average win, this figure doesn't have to be excessively high, as we can see here. Already with a 60% win ratio, we can achieve something I would imagine is quite satisfactory. So, and another thing to bear in mind when we are going to do the back testing, obviously you want to back test on the markets you attempt to trading, who you're trading in. But you also need to back test on the trading hours where you expect to actually be trading. Each market, many markets are 24 hours now, and especially Forex markets. And let's take the Forex markets for an example. Let's say you want to trade euro dollar. You need to do your back testing at the same hours as the ones that you were trading. All the back testing software that I mentioned earlier, they show you the time and as well as the day of each candle as you go forward through the chart. So you can see when you should be putting on the trade, your fictitious trade or not. And you want to avoid market hours where you won't be trading, because, for example, the euro dollar tends to make most of its moves during European and New York hours. And when Europe is closed and New York is more or less going home, those hours tend to show more sideways action and do not have a very big tendency for trending. So clearly this creates an issue. If you're trending and you're not going to be in front of your computer during European hours, then using a trading strategy when the European market is closed may not be convenient. And your backtesting will probably, if you're backtesting your strategy in European hours, but then you're trading in non-European hours, you're probably going to have a very big difference in live results to your backtesting results. So it's important to, whatever market you choose to trade in, to keep your back testing to the hours you will be in front of your computer, you will actually be trading. And also to back test on the markets, actually do the back testing on the markets that you will actually be trading in. I say this because there's often the temptation to, let's say, to backtest your trading strategy on euro dollar and sterling dollar, and you see it works very well. You take it to the live market, you start trading on live markets on euro dollar and sterling dollar, and you have an idea. You think, well, maybe I'm going to trade this on another financial market. You're interested in precious metals. Maybe you think of trading your trading strategy on the gold market. Well, it could work, it could be effective, but each financial market has its peculiarities, and it's most advisable to go back to your backtesting tool and backtest your strategy on gold, and then see if it actually works. So before you actually apply your your trading strategy to a different market to the ones you did the back testing on. It's very necessary to go back to your back testing tool and back test your strategy again and see if your execution plan actually holds out, if your stop losses perhaps are not too close or not too far away, and so on. Another thing I like doing to keep it simple more than anything is to create an account size on my backtesting model that is the same as the money I'm going to use in my live trading account. I don't think it's necessary to create a backtesting model with let's say $100,000 if I'm going to be trading $10,000. It's true you can simply multiply things, but I also believe it's just much simpler, much easier to have everything defined by your backtesting model. So if you're going to use a $10,000 account, backtest with $10,000, because backtesting will tell you what size your trades should be and how much margin you can in pips you can put on the trade, and how much that will equate to in dollars of risk. And that way you don't have to downsize anything if you're using, or upsize anything if you're using a different amount of capital on your backtesting model. So just to make things easy, and so everything's all sort of very streamlined, and you recognize your trading sizes, you recognize your stop loss margins, you recognize what dollar risk you have on each trade, much easier. It's better to keep your backtesting model at the same size, keeping the account size at the same size as your live account. And right, and lastly, this probably whoops. And lastly, the next thing is risk management. So I mentioned earlier that when we set out trading, we might have, okay, we might say, okay, I have $10,000. I'm going to invest in a trading venture, and I'm going to start trading with a $10,000 account. But before we actually do any of the back testing, as we saw, we have to determine what our risk tolerance will be, because as I mentioned earlier, there's no need to start trading with $10,000 and trade it to zero. If you start losing money, clearly something's happened and it hasn't gone wrong, and something's gone wrong. It's necessary to stop. So yeah, we have to establish first of all what our maximum drawdown will be. Maximum drawdown, or a maximum amount of money we are willing to risk before we stop trading, to have a look at what is going wrong, right? So when you establish your maximum drawdown, let's say 1,000, 2,000, 500, and so on, this will also give you other insights as to how much money you can risk per trade. For example, if you have decided that your maximum risk tolerance is $1,500, then you're going to need to establish how much risk you can put on each trade. And if you have $1,500 of risk per trade overall, maximum drawdown, you might establish, I'm just giving a number off the top of my head, but it depends on how often you want to trade, what size you're going to trade in. You could establish that your maximum stop loss per trade is $75, which would be around a 20th of your 1,500 maximum drawdown. This kind of makes sense, because if you're willing to, if your maximum risk is $1,500 before you stop trading, it wouldn't make sense to put on a trade where you're risking $500 because that's a typical example of 3 strikes and you're out. Yeah, you put on three bad trades of $500 each, and you've reached your maximum drawdown, and you would have to stop trading and analyze what happened. But the reality is, you only had 3 trades, which is a very small number. So that doesn't make sense, right? Perhaps my $75 is too small, because it would limit the amount of capital you would be able to trade with. Not capital on your account, but the amount of trading size. Yeah. So let's say you started your back testing with $10,000 because you have an availability of $10,000, and you want to start testing your back testing with $10,000, and you already established that your maximum drawdown will be $1,500. Now, let's say after various backtesting strategies, you came up with a winning strategy with a good win ratio, with a low average loss per trade and a high win per trade, but it had a maximum drawdown of $2,000. It's a very simple way to solve this problem, because apart from the maximum drawdown, which was perhaps too high, because it was 20%, you could sort of tweak this a little bit and decide to trade the amount of capital that you would need, so that you would only lose 1,500, right? So you change you do an equivalence. 2,000 to 10,000 is the same as 1,500 to 7,500. So you could say, okay, I'll start my account with 7,500, and my stop loss will be 20%. Be 20% because that's the maximum drawdown I saw on my back testing. My back testing produced a maximum drawdown of 20%. It never went lower than a loss of 20%, right? So I need to see that I'm trading $7,500. My maximum drawdown is $1,500, which equals the maximum amount of money I'm willing to risk. In this case, $1,500 equals 20%, sorry, of 7,500. Yeah, so we would be able to apply the backtested strategy with $7,500 and a maximum drawdown of $1,500, which is equal to the 20% maximum drawdown we experienced in the backtesting. Now, the stop loss, when coming to define stop loss, there are various ways of establishing your stop loss. You can establish it as a percentage of your maximum drawdown, as I mentioned earlier, or you can establish your stop loss as a percentage of your margin. So if, as we decided here, we are going to use $7,500 as a margin to place on a trading account, we can decide to use a 1%, yeah, of margin. In this case, that would be $75, right? So we need to establish our stop loss, because through that, we can find out how many pips we can risk on a trade. So for example, if you're trading euro dollar and get into a trade that you buy euro dollar at 1.10, you need to know how many pips away you can place your stop loss before breaching this rule of maximum stop loss. Yeah, because if I buy at 1.10 and I don't know where my stop loss will be, or if my stop loss, according to the charts and according to my technical indicators, indicates to me that my stop loss would be at 109. Well, I don't know if that's really, to begin with, it's not reasonable because I cannot place that trade because it's not, it's too large for my maximum stop loss, right? But I can also size it down, and we'll see how we do that. I can size the trade down, I can size the trade up to fit, yeah, my stop loss. But if I have a stop loss in dollar terms of $75, and let's say to begin with, I look at using a trade size of $10,000, I can see that my maximum stop loss in pips would be that $75, my maximum loss, divided by $10,000, the trade size, and that equals 0.0075 in the euro dollar price, or in colloquial terms, 75 pips. So if I were to buy $10,000 at 1.10 of euro dollar, I know that my maximum stop loss has to be at 1.0925. If my charts are telling me that it's inside that, I know that I'm comfortable with that trade because my stop loss is not greater than my dollar amount. Yeah. Now, if the chart tells me, for example, okay, your stop loss is going to be 37.5 pips away. Yeah, this could also be another scenario. Let's say I put on a trade at 1.10, and my trading strategy, my execution and plan is telling me that the stop loss is at 37.5 pips. Well, now I need to know what trading size I can use to take advantage of this trade. And the trading size is given by the $75 my stop loss in dollar amount, divided by the number of pips, which is 0.00375, and that would equal $20,000. So then I would know from this calculation that on this particular trade, I can trade with $20,000. Yeah, because my trading plan is telling me that my stop loss is 37.5 pips away, and I put that into this small formula. I divide $75 by the number of pips, and I get the trading size. In this case, would be $20,000. It's important to understand the relationship between your dollar stop loss amount and the pips, yeah, of the markets you are trading in. Because if in this example my stop loss is 75 pips away, I understand that I can only trade $10,000. I can't risk more than $75 per trade. And so it's important to understand this relationship to take advantage of trading in larger sizes. Okay. All right then. So I think I'm pretty much done. Does anybody have any questions?
Before that, I want to say thank you to you, Gino.
Thank you all.
Crunching numbers, that's not an easy task.
Yeah, I know. I tried to make it simple, but
you have walked us through the process. So far, I am getting a little more comfortable with the concept of trading, and I assume or I believe that our presenters might think the very, very same way. Thank you very, very much. Your presentation's been really awesome, and we have learned significantly from you. Let's go to our presenters right now, and the first one who's been ready for a little while is Solo Timothy. Go ahead at this time, Solo, for your question. Solo, Timothy. Your audio settings on your end, please. Your microphone is still off. Go ahead, Solo, turn your microphone on, please. We're not getting Timothy at all. I want to apologize for that.
That's okay.
That is very, very unfortunate again. But ladies and gentlemen, remember, this is a topic of importance, regardless of your level of knowledge when it comes to finances. Give me a second, please. Regardless of your level of knowledge in the field of finance, it is all for you. So that's why right now we are ready for your question. Is that you, Timothy Solo? Go ahead. We can hear you very well right now, Solo. We are losing Solo. Too bad.
We lost him.
Yeah. That is really too bad. We all understand the ideas of entry and exit points so that your trading strategy can be fully functional and effective. This is the key. You've got to be fully aware of your trading strategy and your risk management skills. Those are things that must be considered and things that you've got to do before you jump in. I'm watching the room right now to see if there is any hand up. I remember, Gino, we've got to go back to the 90s. I didn't know too well at all about trading, about investing. And I took a little risk putting $10,000. That was exactly 1996, because people have been telling me about, you know, how they can move ahead with the stock market. So I said, okay, let me give it a try, even if my expertise in education, but I said, okay, so what? Let me put 10,000 and see if, you know, in 5 years, I could become a millionaire. But, you know, guess what? The first 13, 15 months, things went very, very well. Within that time frame, that account had about $55,000 from my initial entry point of 10,000. But you remember the crash in 1998. It was a severe crash. I was very, very happy when I saw that amount in my account for that investment. And I said, hey, very soon I'm going to quit my teaching job, because I'm going to be super wealthy, super rich. But then, boom, the crash came up. And within more or less the same amount of time, about 12, 13 months, that 55,000 went drastically down to about $7,000. Yeah. Ever since, I stopped getting involved in any type of investment. If there's anything that, you know, could make me run, if when people say, okay, let's invest 15,000 here, 20,000 there, I said, not for me. So it was a little true story on my end from my own experience. And as we are still waiting for students to raise their hands for a question. I'm going to allow Raul George to ask a question in a second, but a question of my own that can be important for every other attendee. Is there something called, in my mind, automatic trading, which would allow me, even if my risk tolerance is fairly low, so that if I put 20,000 in there in some kind of market, you know, I could expect maybe, you know, for the system to do the trading on my behalf automatically, so that I have a very low risk tolerance. The most I could lose, it could be something around $500. Is that something that exists, Gino, automatic trading?
Right. Something in terms of automatic trading that has such a low maximum drawdown, I don't know any. Okay. What you describe exists. Something where you can put your money, a platform or a broker with automated trading systems that you can place your money and watch the automated trading system do it for you. And over time, it usually has a positive performance. But I don't know any that would have a maximum down of $500 over, let's say, $20,000.
Great. That's a very, very good response. I love that.
Yeah.
All right. It's your turn now, George Raw.
You have to unmute. Yeah.
Okay. Yes. All right. Are you all hearing me?
Yes, very well.
All right.
Yeah.
Okay. I have a little experience with trading, and I must say that first of all, if you permit me a little time, just to indicate to the university, I must say this is one of the strangest universities I've ever come across. I have been to a few universities, and you get no type of information like this. And I mean, this is excellent. I must say, I must commend Atlantic International University. I mean, this is really strange, different. I am really, I'm pleased. So, after having said that, let me go to Alessio, the question.
Yeah.
One, and this is just a hypothetical question, but if you what would be the total sum that you will, let's just say on a $10,000 $10,000 you want to invest, that would be what percentage you would say would be the most appropriate amount for any one trade?
For one trade, for the maximum risk per trade.
Yeah, per trade, yes.
Yeah, I think it depends on the individual, but I would imagine personally that nobody should be risking more than $200 per trade. Right? I start that assumption because I would say that no individual would want to lose more than 20% of that account, and 20% of that account equals 2,000. And I would expect you want to put at least 10 trades before you find out that something's not working, and 2,000 divided by 10 is $200.
Okay, fine. Now, if you don't mind, I have about 2 more questions to ask, because this is something of great interest to me. So the other question is, now I know you spoke about various elements or aspects of trading. Now, a lot of people, and I have done a little bit of it in terms of the technical analysis, but I know there are other things that may move the market. So you may set up your trading in terms of using a technical analysis, but as Dr. Valson would have said, because of certain circumstances, that profit that you could make could dissipate in less than a quick time. And it might be less than a few months, because I could remember doing a trading once, and I made the mistake because I said let the profit run, because it was doing pretty good. It was the Japanese, the US dollars and the Japanese yen. And I did not put a stop loss. And that money went up to almost $30,000, if I remember. And there was an earthquake or something. And when I left and returned, it disappeared. So I know what you're saying is proven, the importance of stop losses and that sort of thing. But
I didn't mention it. Yeah, I didn't mention it directly, but stop losses are very important.
Right, yes.
The way I was describing the strategy was that the stop loss is always in place. Because no trading strategy should be without a stop loss. Regarding the point about non-technical information, yes, very important to understand the fundamental side of any market. And for example, if the Federal Reserve is having a meeting perhaps you don't want to trade when the Federal Reserve is having a meeting and Powell is giving a speech. And if you see the market, it goes up and down, it's practically impossible to really be able to trade that. So you have to know these things, for example, when you want to stay away from it. And then there's also economic data releases, for example, non-farm payrolls or GDP data or inflation data. The traders often stay in front of their computer and see if there is a surprise data and trade on the back of the surprise. But that's, let's say, a very small part of trading. Again, you can, as long as you know when to avoid the markets. For example, if central bank is speaking, it's better to stay flat. And for things like earthquakes and unexpected news, there's no protection other than your stop loss, of course. If you put a stop loss.
Yeah. So it means to say that if you're using a bot or something like that, those type of instruments, it may not necessarily work in your favor if you're using them. And because I'm not certain if they take into consideration, when you're using these bots, they take into consideration these news that may just happen just like that. And I'm not certain how that fits into the whole logistical schema, right? But my final question will be, I know on the market, we talk about Forex and we talk about options. Would you advise persons, which one you think is more appropriate in terms of, if you have a little experience, whether or not, because we know that options could run in quick timing, while in Forex you could test the market and do a back testing and all of that, and then you put in your trade and so on. What are your thoughts in relation to that, Forex as opposed to options?
Well, I think Forex is probably one of the easiest markets to trade, because there's no intrinsic information. All the information about currency movements is in the market, because central banks issue data, governments issue data. And so the data necessary for fundamental analysis is all out in the open. Excuse me. So maybe it's a little bit easier than the stock market, but options, the thing about options is that you have to understand very, very well the dynamics of an option. And I always think options are for two types of people. Sophisticated institutional players that trade volatility. In reality, they don't trade the actual option as an option. They trade the volatility, which is something that makes up the price of the option. And then there are option sellers and institutions that use options to hedge a portfolio. So if I have a portfolio of stocks and I don't want to sell them, but I believe the market is going to go down, maybe I buy some put options to protect my portfolio. And what is very, very sort of indicative is that there are hedge funds. There are hedge funds that all they do is sell options. Okay, so obviously, if there are hedge funds that all they do is sell options, it must mean that the probability of the option being profitable for the option buyer is very, very low.
All right.
All right. So thanks very much. Yes.
Thank you very much, Gino. Thank you very much, Walt George, for your questions. Afonso Ngola has been waiting for a little while. It's your turn now, Afonso.
Yes, good morning, everyone.
Good morning.
Good morning.
Good morning, and thank you for the opportunity. First of all, I would like to say that this is a really good opportunity, because the economy is a part of our life. We cannot live without thinking about money, how to pay, and to do so on. So going directly to my question, I would like to say that I never been experienced on this kind of trade and stock. All this it's new for me. And the first question is, so when you are talking about trading the stock, you mean the trades mean buying a stock, right? That's correct.
Yes, you can buy the stock or you can sell it. What it's called is sell it short, meaning you don't have the stock, you borrow it, you borrow the stock from a broker.
Okay.
And you sell it to the market. So you can buy or sell stocks as part of trading.
Okay, thank you. So let me say that I'm talking about myself, that I had no experience. Today I decided to involve in this kind of business. So what could you, or what kind of stock could you advise me to start with that you think that represent lower risk, because I know the risk will be always there?
Right. Well,
then
I
those who are with high risk.
Yeah. Well, if
and
you want,
which are that stocks, the kind of that stuff. So
the kind of stocks you want to look at are large capitalization stocks, large cap stocks, for example, but not technology stocks, because they tend to be very volatile. Blue chip stocks, for example, General Electric, Coca-Cola. These stocks tend to go up and down like in a very stable manner. It's not like Amazon that maybe is up 5% over a week and then the next week it's down 5%. These stocks tend to have a more stable dynamic. So blue chip stocks, very, very large cap stocks. And I would stay away from technology stocks that tend to be more volatile.
Okay, thanks. The second question is, understanding what you're saying, I would like to know if a part of buying, there is any stock that I can invest and I get return like a long term, is that a fixed rate, or all stock have to be getting on the time being sale or being sold? For instance, like I'm trying to bring this window. If I want to make investment on the bank, okay, I give a loan to the bank for such time, like a buying CD, which is take 3 months, 1 year, 6 months, depending on. So there is a fixed rate. Say that at the end of this period, they gave me like 3% of my investment. So it's the same. That's the same strategy happen in trading or not?
No. Stocks are purely variable in value. So you could buy a stock today at $100, and in a year maybe it's worth 150, or maybe it's worth 70. Depends on the performance of the company.
Okay.
And there's no guarantee. However, having said that, some stocks pay a dividend, and stocks that pay a dividend we know about because they declare it. They declare that they pay a dividend regularly.
Okay.
So some stocks, even if the price fluctuates up and down, maybe they pay you $1 or $2 or $3 a share in dividends. So in a way, some stocks, you have that income of money every quarter, every 3 months, which is when they pay the dividend. But you have to investigate which stocks you're looking at, if they pay a dividend or not. But generally, the risk in the stock market is much greater than anything like a bond. Because a bond, you lend, or a CD, you lend the money. At the end of the maturity, they give you back the money and they give you interest for the loan. Stocks is much more risky.
Thank you so much. That's our last question is, okay, so how to get access to invest the stock? Do I have to go to the banks? There's how, if
usually you can get access to stock market on an online broker. If you do a search on a web browser and you put online stockbroker, I'm sure you will find many. that operate in your country, and then you can compare, you know, look at one website, look at another, compare the fees, make sure they are regulated by your financial securities authority in your region or in another region, but that they are regulated. So make sure they are regulated and check the fees, because each broker has very different fee structures.
It's like Fidelity and TD Ameritrade. Those
Yeah,
are
those are two. Those two. Yeah, those work. Those are very popular, I believe.
Ah, okay. Thank you so much.
Thank you very much for your question, Alonso. With that, ladies and gentlemen, we are
sorry to interrupt you, Dr. Balsing. Let me just answer the question in the chat.
Okay.
Is the stop loss standard or does depend on the budget? Let me just answer it. Well, I'll answer you live. I obviously you can hear me. The question was, is the stop loss standard or does it depend on the budget of our business? Good afternoon, Kamimba. Thank you for the question. Well, the stop loss depends on your budget, because if you have a maximum drawdown, you can go about it in many ways. But one way of going about it is establishing your maximum drawdown. Let's say it's $1,000, and you don't want to lose more than $1,000. If you lose $1,000 or more, you're going to stop trading. So you start with $1,000 of maximum drawdown, and you divide it by, let's say 10, or divide it by 15 or by 20, which gives you a number of trades before you would be stopped, and you would have to stop your trading, right? So if you had $1,000 and you say, okay, I want to be able to have at least 10 wrong trades, well, then that equals $100 per trade. I hope that answers the question.
Thank you very much again, Gino D Alessio. Your presentation has proved to be world-class, and we are all happy to have had you to do that live session for Atlantic International University. I know there's been a lot from your presentation, and very often, as usual, as a matter of fact, participants ask that question about where am I gonna get this huge encyclopedia about the presentation. Well, there are three options, ladies and gentlemen, about getting Gino D Alessio's presentation today. Number one, a link. Don't forget the session has been recorded. Number one, that recording will be sent to you through a link via your email address with Atlantic International University. Number two, the recording will also be put on your student portal after you log in. It's going to be there for you. And the third option is to just go to Facebook, you know, from your computer, tablet, cell phone, and type in Atlantic International University, and you will see that recording. It's being, as a matter of fact, broadcast live as we speak at this time, and that recording will be kept within the Facebook archives, and you will be able to access that recording as well. Several options for you, dear participants, not to lose anything at all from that wonderful presentation from Gino D Alessio. Thank you very much on behalf of Atlantic International University. And before we say goodbye to each other, Gino, the last words from you, please.
Yes, I just want to make everyone aware that trading is a very exciting activity. But it takes a lot of dedication, a lot of discipline. I mentioned discipline because the trading strategy that you might one day define, it takes a lot of discipline to stick to it. So even when you backtest it, you may not even stick to it when you're backtesting it. So imagine that when you're trading, if you don't stick to your trading plan, you can't know if it's effective, and you can't know if it's produces a good result. So it's very important if you do the back testing correctly, to stick to your trading plan, to be disciplined, and bring back discipline to your live trading, because it worked in the back testing. It's most likely going to work on a live account, but only if you're very, very disciplined and you stick to your trading plan. So good luck everyone who might be looking to get into trading. It's difficult, but it can be rewarding. Yeah.
Wow, I am impressed. Thank you very much.
Thank you.
Cherished participants, the mics are now on for everybody to just say thank you to our wonderful presenter, Gino D Alessio at AI.
Thank you, Mr. Gino.
Thank
Thank
you,
you, Mr. Gino.
Thank you. Thank you, Mr. Gino.
Thank you.
Mr.
Thanks,
Gino.
thanks, thanks,
Thank
thanks, thanks
you.
for, thank you.
You
Bye-bye.
will be live.
Goodbye.
Thank you very much. Goodbye and God bless you all.
Thank you.
See you next time.
Thank you all.
Thank you very much. Thanks.
Very
Bye.
much.
Wonderful.
Thanks so much, Gino.